The difference between a hedge fund and a private equity fund. Definition of hedge fund. A hedge fund is an investment fund that pools capital from accredited investors or institutional investors to invest in a diverse range of assets and financial instruments. Hedge funds aim to generate high returns for investors by employing various investment strategies, including long and short positions, derivatives trading, and leverage. Investment strategies. Hedge funds often use aggressive and complex trading strategies to capitalize on market opportunities and inefficiencies. These strategies may include hedging against market downturns, arbitrage opportunities, and speculative trading to achieve above-average returns. Risk management. Hedge funds focus on managing risk through sophisticated strategies such as diversification, hedging, and leveraging. They aim to minimize downside risk while maximizing returns, often targeting specific market niches or opportunities. Investor requirements. Hedge funds typically require a high minimum investment from accredited investors due to their sophisticated strategies and higher risk profile. They are often structured as limited partnerships, where investors contribute capital and share in profits or losses. Liquidity and transparency. Hedge funds may have limited liquidity, with restrictions on how and when investors can withdraw their investments. They also tend to operate with less transparency compared to other investment vehicles, disclosing holdings and performance data selectively. Definition of private equity fund. A private equity fund is an investment vehicle that pools capital from accredited investors to acquire equity stakes in private companies or invest in private equity securities. Private equity funds focus on long-term investments in companies with growth potential or undergoing restructuring. Investment strategies. Private equity funds aim to enhance the value of their portfolio companies through operational improvements, strategic initiatives, and financial restructuring. They often take a hands-on approach in managing and growing their investments over several years before seeking an exit strategy. Risk and return profile. Private equity investments typically involve higher risks and longer investment horizons compared to hedge funds. However, they also offer the potential for significant returns through capital appreciation, dividends, and eventual exits through sales or initial public offerings, IPOs. Investor requirements. Private equity funds also require high minimum investments from accredited investors and institutions. Investors commit capital to the fund, which is then deployed over time into various private equity investments based on the fund's investment strategy. Exit strategies. Private equity funds aim to realize returns for investors through strategic exits, such as selling portfolio companies to strategic buyers or listing them on public stock exchanges. The timing and method of exit are crucial for achieving optimal returns on investments. Understanding the differences between hedge funds and private equity funds helps investors assess their risk tolerance, investment objectives, and financial goals when considering alternative investment options in the financial markets.